Hi, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And today we are going to talk about some recurring problems in the state of California, some trending stuff that's happening in real estate, and sprinkled in there some hope on what you can do if you are an aspiring home buyer or investor. But also some stuff today we're going to talk about is general for the consumer regarding the credit, some insurance stuff like that. So, guys, let's get right in from the top. We're going to talk about house flipping first. So this is actually from Brian. This was from Bankrate, right? Is this you found this one at bankrate.com?
Shout out Bankrate.
Hey, they're showing up a lot more these days. I like that. How to flip a house.
You know where now you know where I'm looking for information.
They're looking for leads and they're trying to get traction and eyeballs and attention, all that. But hey, we have stuff to talk about that's actually relevant to people. So today from Brian and Bankrate is how to flip a house, a beginner's guide. So essentially here, the article is covering like what is house flipping, how can you do house flipping, some pros and cons. So we'll talk about a couple of things, and then I want some like kind of on the ground experience on the lending side, the real estate side, and being able to sit at the table with an investor who's done some stuff like that. We want to get some experience from Memo here. So clearly, in case it's not abundantly obvious, the evolution of house flipping through HGTV and social media has just been like this wildfire, pun superintended.
The whole DIY.
It's been gone wildfire these last couple of years. You can rest this at the feet of all these different shows that have been like House Repair and the Joanna and Chip Gaines stuff and Extreme House Makeover and all that. Like,
I mean, everywhere you look, not only there, but if you go on social media, there's a lot of these platforms out there, the whole Burr method, of how to just flip, fix and flip. I mean, there's a little bit of everything, and it's just gotten so popular. As a matter of fact, you're seeing that, year to date, it's about 35% of homes being sold are from investors.
Yeah. So, and that's a little bit more than normal, like the normal average. I think in the article here it said, first quarter of 2024 alone, 68,000 of the homes that were sold were flips.
That's 1 out of 12.
1 out of every 12.
That's crazy.
That's a lot. That's like 8% just in the first quarter.
One of the things that I do notice that HGTV over glorifies is like when they put two regular people on there and they're like, hey, I'm a teacher and I'm a stay-at-home mom. Our budget is $3 million.
But
I understand
those
why
memes are funny.
But I understand, why they do that, because it also tries to invite regular people to let them know, like, hey, guys can also do this. But in the pros and cons, there's something that is very, very important that I don't think people really understand and really get into it once they like, I'm gonna fix and flip, I'm gonna get into investing. You really have to have everything dialed in.
No, exactly. And you need to have some deep pockets. Yep. The article is really good. Actually, it was very well written. It talks about the pros and cons. It talks about the general profits that they're making. So it gives you a good description. I mean, obviously, we're going to add our take based on the experience and knowledge that we have while we work on our own project and work with several investors. As a matter of fact, the last year, we've been doing more fix and flip loans, which has been incredible. And it's actually been what a way to go and leverage your money, So it really all depends on the experience. The more experience you have, the less money it's going to require you, to put down. Mm-hmm. But Andy, what is house flipping?
So the house flipping is essentially buying a property and holding on to it for a shorter period of time than a normal person would that's going to occupy it. And then you buy it and flip it, or you buy it and update it intentionally to flip it. Yeah. Like car flipping or anything like that. Anything else that you'd be like hobby flipping.
Oh, wow. Great. On to the next episode.
On to the next one. But obviously there's a lot more that goes into it, but essentially it's, short-term acquisition for trying to turn a profit.
Yeah. I mean, some of the things I like about house flipping, is when you're buying them in certain areas, it does help fix that area. You're seeing a lot of like Barrio Logan here in downtown San Diego. Yeah. You saw a lot of house flippers out there. In some areas with San Diego, they allow you to kind of do a little more stuff. They're a little more flexible with you.
You know what I have seen around those areas is more of like houses with businesses combined and stuff like that you're able to basically mix use exactly a lot. And what you see is that these areas are really torn down. But once one investor gets in there, then a lot of people start seeing like, hey, this is going to be the next place. So everybody starts merging there before they start finding other little pockets in their
Yeah, it's like before when I was growing up, it felt kind of like you don't want to go over there.
Yeah.
It kind of felt like, bro, I might get jumped. Now it's like,
now
it feels a lot better.
Yeah. So I think part of that is the attitude of the person coming in to flip. Like, hey, maybe I'm from that neighborhood, and I want to have that neighborhood's got to come up and on its way. The other part is like gentrification is really the word we're kind of dancing around here, but. Like I'll speak specifically to the west side of Chula Vista right now. There's the Bayfront project going on. Well, there's also a lot of surrounding neighborhood that hasn't been touched in 30, 40, 50 years. And going into that area, knowing that this other new development is about to pop off and be done in the next year and a half or so, that's going to increase real estate values, and it's drawing people with money to the areas to buy them and upgrade them, add to them, create more square footage, put duplex, triplex, whatever, and it's bringing a lot of fresh money to areas like that for that purpose of flipping.
No, definitely because of that. Actually changed when my mother-in-law was trying to sell her home, which is maybe about 2.5 miles from there.
Yeah.
I'm like, I'll keep that. I'll buy it. What do you want? That's the market value. I bought it at market value, and I want to make sure that I build ADUs and the junior ADU on there. So I'm building 2 ADUs on it, 2 bedrooms, 1 bath, you know, with an existing 3-bedroom, 2 bath. I really think that that's going to be in our favor, especially having, that convention center there and just that build, which is one of the most expensive projects there is.
I do believe it's still the largest hotel project currently underway in the United States.
That's
right here in our backyard.
Yeah, right here.
Which is awesome.
Just to put it into perspective, the price point appreciation, the house next to Mary's house is going to be it's up in the market for $1 million.
That's crazy. That's unheard of.
And it doesn't have the build outs that you're going to be adding to the property or anything like that. So just for that to be already the baseline of what the houses there is at, I'm like, it's ridiculous.
Yeah.
But if you do go down the street a little bit further, there's houses that are literally tanked. They're literally like nobody's touched them before, and they're literally like still within the vicinity of everything could be nicer on
Exactly.
here.
That's where this whole house flipping. I see a lot of the homes in that area actually kind of going. But I do like in this article where it says the house flippers need a lot of money on hand for upfront cost of purchasing. Here it is in the beginning. It really is, Andy. You do need that you need to have a lot of skin in the game because you kind of have to prove yourself, right? That you did your due diligence, etc. But for people who've already been doing 2, 3, 4 flips in the last 20, 24 months, like we offer products with just 10% down. So you put 10% down on the property and then we give you the rehabilitation costs. So if the rehab is $100,000, we provide that financing to you as well, but it's got to meet a certain loan to value for that. So as long as the investor's doing their due diligence, a lot of times they don't have to have such deep pockets,
Well, this brings up the budgeting part of the commentary here, which is like one of the main things that they're telling people who are reading this that are interested in like the step-by-step part. They're mentioning budget like right out the top. And I put a close second, like your contractor. I know in the article, like, contractor's like number 5 or something like that. And I was like, no. Like that has to go with budget because the contractor partially sets the budget with you. I mean, exactly. You're going to pick the kind of treatments you give the house, whether it's going to get carpet or hardwood floor or tile, and then what kind of stone and whatever. But you have to have a contractor that can come in at budget and stay within the budget too. So like to me, those go hand in hand. And to your point, like, it's great if you can finance that, but you have some upfront stuff like permits, architectural drawings, renderings, things like that you have to go just pay because they're part of the deal.
Well, we, permits aren't required, in San Diego, depending on the project, unless you're going to add something else, but if there's already a bathroom there, you're just going to fix it. There's no permits required.
Right.
The only difference is, and I'm glad that you brought that. I mean, we kind of went a little really fast on that, but the pros and cons, I like the article, the way it breaks it down. I also like, some of the housing steps, and contractor was one of those. Here in San Diego before, you can do everything without a contractor.
Yeah.
But with the new rule that came in effect on July 1st of 2024, they put a new bill, which is the AB 968. So now you have to show all the receipts and all the work. And so now doing it yourself is kind of like, I don't know,
corners.
Depending on the work you've done.
Yeah.
So if you're doing big work and you're putting anywhere from 80 to 100,000, in this case, that rule doesn't apply to like paint, exterior paint, interior paint.
And I don't mean to jump around. I don't mean to take us out of like a linear conversation
that's
of
good.
pros
I'm
and
glad.
cons. But the reason I brought it up is because when you're talking about bringing up the neighborhood and some of their pros, as far as like, making profit and whatever, like that ties in with the budget and your contractor greatly.
Absolutely.
Because those things are going to affect the top line and the bottom line along the way. And so part of it is having someone who's experienced and has a good track record. If you want to bring the neighborhood up, well, someone's got to show up who can actually do that, right? So I know it's out of linear time in this discussion, but
it isn't.
But they're connected still.
Yeah.
So there is the potential for big profit, and you can improve the neighborhood. And part of what we also know for people that are doing this now is they're looking to diversify themselves financially.
Correct.
That, okay, well, real estate is a smaller part of my portfolio, if you will, or not a part at all, and I want it to be. I have a house that I can convert or add to or whatever. Yeah. And so this is a way people are doing it to increase cash flow and offset monthly costs and that are pressing on their budget financially.
Exactly.
So there's risks in having the wrong contractor or having the wrong budget or trying to do it in the wrong area or for the wrong reason. I'm even gonna say the wrong reasons. Like the wrong reasons isn't listed as one of the cons, but you could totally go into this with the wrong reason, and that can bite you in the butt too. I don't want to pretend like that can't happen, because that can happen if you have the wrong intention here.
One of the pros that I feel wasn't mentioned is that compared to buying a regular house, and if you want to go the regular route to buy an investment property, is you right off the bat need to put 20% down if you don't have the experience, or even if you do have the experience going through a regular residential bank loan. With a specialized product that is just for fix and flipping, hard money loans, they actually don't go based off your personal income. And that's what I feel a lot of the public doesn't know, that, hey, how am I going to have the income to be able to afford that property, to be able to fix and flip it and still have, well, no. It doesn't go based off your personal income, but rather, your experience, the deal, and then your exit strategy and what you're going to be profiting. If those numbers align and you have everything dialed in, then you have a high chance of getting your project funded and approved. And that's something that I feel a lot of people think that, hey, I have to have the income. No. As long as you have the funds, or you're able to come up with the funds through, other investors, or you're able to pull money together. All these things change when you're in a new investment world compared to the residential game. So that's something that I feel a lot of people don't know. And if you do know, you're out there playing with the people.
That's a great point. I'm glad that you bring that up, because that's actually a really good point. I mean, you can borrow money from whoever you want.
Yeah.
It doesn't matter, like your tia, the tío, they could all come in there and
it's easier.
I broke my piggy bank. There's 5,000. You don't have to source those funds. It's very different when it comes to that world.
They're just there. You're like, hey,
the real thing only is credit. You do have to have credit.
Yeah.
Obviously, the higher the credit, the better is always going to be. Credit's everything
always.
here.
Yeah.
Right. And then the other thing is experience. But if you don't have experience, it's okay. You can still do it with 20% down. And the cool thing is, you get to kind of get into the game, right?
One of the things that I also feel that I'd encourage a lot of people to do is that if it's your first couple of projects, I would align myself with someone that has the experience or has already done it before. Do a JV venture where you're able to, still be part of that deal.
Yeah.
But at the same time, you're able to gain that experience. And maybe if that person does have prior experience, then those terms will be a little bit easier on you as well. So that's also something to, think about
Get
when
creative.
you're going into. Yeah,
So
exactly.
awesome point. I'm glad you laid the foundation for that, because you've laid the foundation. Because I was just writing here, I'm listening to you guys, and I was like, how can I consolidate this thought? For me, it's like you got to have the credit part, there's the cash part, and then plan for contingencies.
Yeah.
So 3 C's from Uncle Andy. It's going to be credit, cash, and contingencies, because part of this too is like there may be unexpected things that come up. Like what happens if you find this when you uncover the backyard and you're doing piping or whatever? Well, what if you find something like there's just things that come up. What if you have damage in your roof that you can't see, because until you remove the roof to replace it, you don't know that there's like termite damage or something on the eaves. Like there's other problems, and I just want to make sure that we're telling people like, it can be all pie in the sky and great and wonderful, but you leave some room for contingencies, because unexpected things happen, and you don't want to be caught off guard.
And that's one of the cons.
Threatening. That's why.
That's part of it, right?
And it's listed for that reason, is because there can be things that surprise you that end up costing you money, and if you don't have the money to cover it, guess what? Now your deal's completely threatened.
No, totally. I like the way they put the pros, potential big profits. There is a potential for that. They were saying in the article it's about 30%. That's a lot. I think that's
a lot.
Here in San Diego, some investors are like 50 is a minimum. They're trying to make 50, 100,000 at times. Obviously, sometimes they hit home runs. And they're much higher than that. But, I think 30% is too high. But those are the averages.
It could be, and I mean, and even listed in one of the mistakes here is like not having enough money.
Yeah,
and like thinking it's
absolutely.
easy. Like, okay, well, not having enough money and thinking it's easy are like two really big threats.
The biggest issue for an investor, believe it or not, the biggest thing is when they enter escrow, the biggest flaw in an investor is, guess what it is?
EMD.
That's it. They don't have enough money for an EMD. You're like, how?
Right.
So they're just trying to pull from everybody. Just get the deal, and then we'll figure out how to get the money. Which is crazy, right?
Yeah.
And then the other pro was improving neighborhoods, which we talked about, which I think is great. I love that. Always improving the area, and then the diversity of your investments. Always good that if you look at flipping, you kind of just don't put those blinders on. Try to expand your horizon by paying attention to other opportunities. And there's other ways you can utilize the investments, like short-term rentals, long-term rentals. It could be caregiver, where you bring people where you're gonna help them out. And then there's daycare. Some people just utilize their home as a business.
Yeah.
So there's different exit strategies for these different type of loans.
And I think part of that too is that proves the point, or I think makes the point that, you know, having the right team together and having the right contractor who knows what they're doing is part of it, because it's easy, or maybe it's easy to just put your brain on the shelf, like, oh, I'm doing a flip, and like not have to think about it, and like just completely entrust and I'm not saying you shouldn't just trust the person, but it's like, meaning be hands off, and that doesn't seem to be the way it works among our friends, like off camera, that are here, that have done a couple hundred flips.
Oh yeah.
Our friends who have come to Friends of Mortgage Heroes who are currently doing flips, and they're contractors, like they're putting full attention on this. It's not like you're going to get a full result with half effort or half attention span. You have to keep your eye on the price and on what's going on. Someone has to supervise this thing and make sure things are being done in a quality workmanlike fashion and at the standard that the market's going to tolerate.
Yeah.
Don't sell me a crap place for 100% of the price. If it's crap, it's crap, and people are going to let you know.
Exactly. Well, there goes the cons, right, Brian?
Yeah.
What are the cons, Brian?
Oh, did I blow through them?
No, you did not. But but those are it, right?
Don't flip crap.
All that's part of that, right? There's also a potential for big losses, right? Is what they have. Likelihood of significant problems, which you brought up. You know, you're going into, you start opening walls, and next thing you know, you're having plumbing issues. You take the carpet out of the flooring, next thing you know, you have foundation issues.
Right.
There was just a property that we went and purchased in Texas, and that was one of the issues. Yeah. And then just that issue alone was $12,000 repair.
Right.
So it goes digging into your budget.
Yeah.
Totally chip into that. Well, and so I think there's a lot of positivity around house flipping if you have the right place, the right market, and it really comes down to the right price. I mean, can you acquire the place at the right price? If you're paying 90 cents on the dollar, that might not be enough to pull the deal, unless that house is going to future value be worth way more.
Exactly.
That might be warrantable. But if you're over 70 cents on the dollar, that's kind of the ratio I hear, if you're going to just flip that
75 because
without adding stuff to it.
Yeah, 775 after you added everything into it is what you want as a ARV margin, after repair value. And then that 25% difference, it's based on your hiring the on a real estate appraiser. I'm a real estate appraiser. I'm sorry, real estate agent.
An agent, yeah.
You know, hiring an agent. There's commissions that are paid.
And I'm glad you brought that up, because you also have the holding costs. You also have, you know, your monthly expenses as well. And that's another thing that people don't look at it. You know, all they see is like ARV plus this. Oh, I'm making all this. No. You got your holding costs. You know, you're going to be in there for 4 to 6 months. Yeah. And sometimes it could be a little bit longer. So you're paying every month. The 12-month term is
you're making those monthly payments.
When you said that, it reminded me of the kindergarten when we went to the graduation. The kid is like, I'm glad to pronounce the 2024 kindergarten class, you know, and the kid in the back was like, like it's all over, right? Like I got my investor gets their offer approved. It's like, like no, there's more to it.
No, that's where it all starts. Like, wait,
got a whole lot of work left.
What do you mean? Like, yeah, we just got the offer accepted. So that's also something you got to budget for and make sure that, you know, it's not digging into your profit, your budget, and then you end up actually, you know, not making money. You go under, but at the same time, that's why it's so important that you dial in all your numbers. Your contractor needs to give you a clear idea of what it is that they're going to be doing for the budget, and if you need to add more, add it in the beginning, because once it's closed, you can't go back and ask for more money.
Yep.
You know, I know you guys probably want to go into the next subject. I just love this because I think a lot of people want to probably hear this, but I do like the outlay about how they're putting the step by step, right, Brian? Set a budget, find a property, make an offer, set a timeline, hire a contractor, sell your property. I mean, those are great.
Yeah, those are good pit stops. I was going to ask you specifically, because I put contractor like number 1A. Like there's number 1, set your budget, number 1A, like with your contractor.
Absolutely.
So that's what I would do from the outside looking in. Like,
that's honesty.
It's listed as number 5 because it just has to go in some sort of order, but it's right there at the top, dude.
Oh, no, Andy, the contractor, Brian, you can take
your contractor is everything. You go, you're going to get a wide range variety of different, different prices, you know? So you really have to vet out who's going to be the right one, who's actually going to do the work, or who's just honestly fluffing and talking and telling you that they can perform, and down the line, like, hey, you know, we're not going to be able to get done. Yeah. That's the most crucial thing. And then I follow what you say, and it needs to be up in the beginning, because even when you're going out and seeing properties, if you're not a contractor and you don't know what costs are and you don't know exactly what it's going to cost for you to build that, you know, labor, materials, and all that good stuff, you want to take your contractor to go see the houses with you right off the bat, because then right off the bat, when you're walking the properties, he's going to be like, hey, that's going to cost you around this much. I could maybe get this for that much, and you're already foreshadowing what it is that you're going to be putting towards your budget. So then you don't have to do it backwards where hey, I found the property, now I have to go do my budget. You already know the price point you're looking at, more or less what it is that you're going to put in repairs, so you can do your budgeting, as accurate as possible before,
I mean, hey, I'll share this. If you guys DM us, I'll be more than happy to share our calculator, our worksheet where you guys could plug all these things in. That way you can print it out, have your little clipboard or what have you, and you can write these things down. So we'd be more than happy to pass these on to you
And it
guys.
works magical because you literally just type in the numbers, it gives you your breakdown, and you could really just underwrite a file in less than 5 minutes.
And it has a simple video of how to use.
Easy day.
Our goal is always to educate our investors, our newcomers. We get a lot of those. Again, because social media, DIY, TV shows, etc. We want to help them.
If you guys do want the calculator, if you guys are seeing this right now, just put calculator down in the comments, and we'll make sure we reach out to you and send it over.
Yeah.
We went to preschool. We know how to share.
Yeah. Sharing. Hey, going back to kindergarten.
Yeah, exactly.
You've graduated sharing. All right.
Yeah.
Well, let's switch gears, guys. I want to talk about insurance. I mean, I don't really want to talk about insurance, but we need to talk about insurance because it's a problem here in California. So I pulled an article from NPR. It's actually kind of a readout of a interview that they did regarding this, and it's titled "California Hopes to Lure Insurance Companies Back with Extreme Regulation Overhaul." I don't think that's overstated. Extreme regulation overhaul is kind of the big three when it comes to what is going to happen, what has to happen here in California.
Yeah.
It is extreme because there's so far to go in fixing this problem. Yeah. It is at the regulation level, and it's got to be fixed. It's an overhaul issue. So,
and Andy, here's the thing. This is pertaining to California, but we're seeing this in Florida too. We're seeing it in Texas.
Good point.
So it's happening everywhere, and the whole thing is based on global warming. Right?
Yeah.
Is the insurance companies is just, and then inflation too.
Yeah.
Not only are we paying more for our food and services, but now we're paying more for our homes, lumber, and all that good stuff.
And I'm trying to keep the conversation more towards like what are functionally our problems, and it is happening other places. The cause is a wide variety. I know that we had a very massive fire here in California that year and a half or two ago.
The Ventura one?
And the culprit was a guy who got lost. A guy was lost on a hike, and he had to start a fire. And that fire caught and it destroyed like 1,200 homes or something.
Wow.
And so that was not necessarily a global warming issue, but this person happened to be lost and they were in the trail and that's what happened.
Yeah.
And so but because of that, there's like this domino effect.
Yeah.
When it's whether the culprit is warming or if it's a lost person or it's just a fire that sparks of a car on the side of the road or something like
because
the issue is
their power lines.
The issue is the PG&E one that was a big deal too.
I was like that one.
The issue is that these insurance companies are kind of they're restricted on how much they can increase premiums year over year, but then that's not kept. That's not been in lockstep with the increased price of cost and labor, like cost of goods and labor to do replacement materials. So in this case, now we have like all these big insurance agents like State Farm and Farmers and Allstate and that are like buy California and then maybe buy Texas or buy Florida because they're like, hey, now we're just got risk everywhere, even though they're in the risk business.
Yeah.
I mean, for years, I remember I used to calculate for a single family residence. I would calculate 65. If I went 75, it seemed too high.
Dollars per month, just so you know.
Yeah.
Condos, dollars per month.
And then for condos, it was like, I'm going to always say 30 to 35, sometimes 45. I'd be like, we got to go shop this. And now they're at 85.
Pulling some like files from before, and you're looking at the insurance. I was like, $34. What the? And
what happened? And that was with the $500 deductible.
Yeah.
Well, and so that speaks to the scale that these companies are operating at. Like they could afford at that time to give someone insurance for $34 a month, $60 a month even. But now it's like $200 a month. Yeah. $250 in some cases, depending on the area.
I'm starting to quote at $150.
But
that's exactly right.
My point is that for those who have stayed, that's what's required.
Yeah.
But that even then is somehow still not enough to lure these companies back. I'm saying lure because that's what they're using in the article here. But that's the issue is that they have to get and entice them to come back and do business in California.
Yeah.
And that's an uphill battle because they're going to have to do this like either one-time exception where they can like jump premiums back to where it makes sense. But then the argument on the other side, guys, is, well, they're making billions of dollars. Why can't they just take that from somewhere else and offset it here? I don't know why they can or they can't. I'm not sure if it's an actuary issue, but I understand the argument too, because I've heard that in the comments from people.
Yeah.
Like, hey, these people are making billions of dollars. What do you mean? Why do they need to get lured back to California?
No, totally.
Because they can choose not to do business in here. That's why. They ultimately have a choice.
But I do like the story because it's true.
So okay. So, right now I know that the difficulty in getting insurance is stopping deals. Is that true, or am I overstating that? Is that true or untrue?
So I think it just really depends on the area that you purchase, because now I had a deal that they were in a fire zone area and the insurance was going to be around $370, $350, $370, and that completely shot their DTIs.
Wait, a month? It was going to be $370 a month?
Yeah. And that's here. That's here in
that was here up the street
Eastlake,
in Eastlake, brand new build. The house is probably 2-3 years old, if that. Brand new, and you would think like, hey, it's new enough. There's nothing like, maybe it's a little bit more, favorable for the insurance company to want to have that appetite.
And they're going to build like a park or something usually. So there's like, consider it's brush fire because they haven't cleaned it out yet.
Yep.
Right?
So you're talking like $4,500 a month.
That's what it was.
A year almost.
Yep.
That's nuts.
Yeah.
Well, okay. So then you couple that with the solution, if you will. I'm gonna air quote solution here, because the solution is the California Fair Plan, which was never intended to be
an actual policy,
an actual solution. It's kind of like a absolute last resort if you can't get coverage. It's bare bones at best. But I'm reading here. I mean, it can be very costly. That's also thousands of dollars a year.
Yeah, I know exactly. I mean, you see in the story here, Mr. Boyd, it could be over $8,000 with the California Fair Plan.
$666 a month.
That's a lot.
Yeah, that's a ton.
That's more than a car payment.
Yeah, that basically is a car payment, right? I mean,
depending.
Shoot. So okay.
Depending on your credit.
If the regulation is changed. So I guess this is the thing that is where I understand people are complaining about. They're like, look, if the premiums were that low, but then now we're finding out, or we're being told that they were artificially low, well, then what was the right price? Like, they were making up for that somewhere else to be market competitive. Yeah. So that means that in coming back, maybe Allstate doesn't need to be competitive with State Farm and Farmers because they ain't going to be in town. Maybe you have less competition. That could be maybe a case for keeping premiums a little bit more affordable and have an appetite. But I think it's really more of a risk issue than a premium cost issue.
Yeah.
Yes, they got to make margin. They're a company. They have expenses. I understand people don't like that and they make billions of dollars. I get it. I totally understand. I'm not trying to defend for them. I'm not carrying their water. The point is that something has to bring them back. And if they were artificially keeping rates low before, they're going to have to get an exception to get them right-sized right now so that people in California can actually get insurance. Yeah. It's only going to go so far for so long before people start knocking on the door of the regulation agency and be like, hey, stop effing around.
Yeah.
We need to have coverage in our place because California Fair Plan ain't going to cut it.
Yeah, and what people aren't discussing too, Andy, is next year, well, when people's policies are due, when Allstate and Farmers say we can't renew your policy, that's going to be a lot of people. That's not just originating new business right now, but now they're completely getting out where they're not going to even let you borrow
the renewal.
Like renewal.
No, and
that's a big issue.
What some clients have came back and contacted me once their policies were done this year and last year is that, hey, how do I renew my insurance? And then turns out that they had a forced insurance by their mortgage company. And that's something that, if your policy dies out and you don't renew it, you're still going to pay insurance. The bank requires you to have, your property insurance. So they're going to take it to themselves and be like, hey, we're going to put a forced insurance, and you'll see your mortgage statement adjust. And it's not going to be like, hey, cheap, 35, 30. It's going to be pretty pricey as well. Yeah. So, that's something to account for. If you're not going to renew, you definitely need to find an alternate solution because they're going to pay it somewhere or another.
Exactly. What I like about here with Ricardo Lara, the one that was talking about this article here, is we're on our way to enacting the state's largest insurance reform in 30 years.
Yeah. Yeah, I mean that states right there like how broadly this has gone unaddressed. Part A, Part B, how quickly the replacement costs have just gotten out of control. At the same time, that there's been so much demand for things to be replaced here in California.
Yeah, absolutely. I mean, listen, they're also talking about like tenant rules, right? Of the rents increasing, but if our insurances are increasing, we have to pass that on.
It's going to spill over,
Because I know my house, it increased.
Yeah.
If I was paying, I'm going to say, I don't pay the bills. Poor Tanya, she does all of that. But it went up, like, if we were paying $2,000, it went up to $3,500.
Right.
It's making a difference.
Yeah. Along with everything else that went up.
Along with everything else.
Fuel, utilities, gas,
I'm hoping,
groceries.
Exactly. So I'm hoping that this is these guys are correct and they bring this new reform, and
Yeah.
then it just helps us all out just to even obtain insurance.
Well, yeah. So I think that's good, perfect. So glad you said that. Took words right out of my mouth. It's like we need the ability to get insurance, and then we can handle the cost of it. Because not even having an option, or let's say having fewer options, it drains market competitiveness. That means whoever's remaining standing right now, they can keep their prices where they are at as long as they're solvent and they meet the state's regulatory solvency test. Then they can afford to stay in business, and they don't have to compete with these massive national companies that might be undermining them price-wise, and I think that's where some of that pricing was coming from, like coming lower. Yeah. But now they're not going to really have a choice.
No, it's crazy. Before, like there were so many options. Now, before we're like, don't worry, we'll connect you with somebody. Now it's like before it was like USAA, and now USAA is actually not even doing it. They're going through a third party, putting us in contact with
everybody's going through third party.
Yeah.
I used to call insurance agents. I'd be like, I can do it, and then no, I need this information. When was the roof made? When was the last time they did this? Oh yeah. What's the age of the? I'm like, dude, you're like, what?
It's like a full-on statement of information. But
I'm like, I don't even know this stuff. Like, it used to be just their name, the price of the house, the address. Let's go.
So, well, hopefully these new rules come in place, and they're saying in 2025.
And as much as we're going to bitch and complain about it, look, this results in lost deals. Number one, I already know it does. Number two, this actually changes the amount that people can be approved for. Yeah. Whether I want to admit that or not, it's just true. Yeah. Like if $100 more a month in your insurance than what you're budgeted for changes your debt to income ratio, and now all of a sudden you can't afford because of the insurance premium. Yeah. That means you have to get a lower loan amount, or a better interest rate, or something. You have to have something else to offset that.
Payment. That's going to be a lower loan amount. It's going to be, take another $30,000 to $50,000 away.
Right, but then that means power. now you're unable to go compete at that level that you might have been. So I'm saying that to demonstrate that the ripple effect of this is not just insurance or not insurance. It's I can get insurance, and now there's another problem behind that. So the affordability is even getting crunched because of this too.
I had a conversation yesterday with one of my friend's moms, and she asked me, she's like, when are houses going to be affordable again? She's like, we're at like 97,000 between me and my husband, and I'm like, unfortunately, that's like the bare minimum entry to be able to afford something, and even then, you could only use 50% of your income minus your debt. So she's like. What? Yeah. And I'm like, it sucks to say that, what's driving prices up is that there's no inventory. It's not like, hey, when's the market going to crash? Unfortunately, we don't foresee that happening. And fortunately, there is people out there that do have the dual income that are above 100,000, and or some are making sacrifices. But it isn't something that like right now anybody could get in and buy a house. You really have to be prepared, or you have to be well approved, or have enough money in the bank or in your pockets to be able to stretch out your purchase price if needed. Because even in the higher price point ranges, we're seeing people like go up in price. Like one house that one of my clients was looking at for 1.8 million is talking about offers getting received at 2.1.
Yeah.
It just depends on the area.
Yeah, that's going to be a problem for people. And
that house is going to have a pool.
Yeah.
Higher insurance.
Yeah, exactly.
And insurance.
Imagine the insurance on that property.
Yeah.
Yeah.
It's going to be a lot more.
The troubles are on the horizon are underscored by a multitude of variables. There you go.
That's it. That's it. Moving on.
On to the next one, guys. We need to talk about the average U.S. FICO score. It dips as consumers struggle to make ends meet. Womp womp. This is from Forbes. This is, I kind of guess what I was expecting at some point.
Yeah.
You can only have enough warning. I mean, not enough. Yeah, how many warning signs in the economy do you need to see, or from the Fed, or just from prices and all that, before you go, uh-oh, trouble ahead? And here's some evidence of that looking back. You saw that the average FICO score in the United States dipped near the end of last year, end of 2023, and it was the first drop in a decade, signaling it may become tougher for some borrowers to finance big-ticket items like cars or houses.
In a decade.
So, again, long time frames again, where, hey, new record. Great. What a fun
breaking
record.
All the worst records, huh?
Yeah.
For me, it comes to no surprise, like with higher costs of like goods, services, products over the last 2-3 years, of course, the credit cards are going to be having to carry the weight if incomes aren't rising, and they haven't really over the last couple of years. So those who haven't had that, income match with the cost of goods, and everything has been going up as well, then you're really going to have to turn to an alternative way of being able to keep up with what you need to pay every month, every day, whatever it is that you have to get by, because you still have to pay that same amount, even if it's more than what you budgeted for before last year. I mean, you brought up an example where the guy's shopping at Walmart and he has his cart from 1 year ago compared to this year, and it's just getting smaller and smaller and smaller of what you're able to basically purchase with your dollar.
That was actually Andy. It was like he spent like $400.
It was the same items in the cart were $400 and change. It was like $140 or something a year or two prior. But the issue, it's like the everyday purchases, right? If your income's not keeping up with the accelerated pace of the price of everyday purchases, then you're going to resort to the credit card. Well, now the problem today is that it's not the credit card rate of before; it's today's credit card rate. So you have, FICO not as a result of just credit cards only, but look, that is a huge driver when it comes to how much consumer spending is happening, and we see credit card totals passing 1.1 trillion in the first quarter. So it's like it's all this problem, but like at scale. Like, oh, I'm having this problem in my monthly budget. Oh, and so are millions of other people. Yeah,
no, exactly. I mean, this comes at no surprise. And again, unemployment has risen. And so that's what the Fed wants. In order for inflation to start going down, we need to see more unemployment. As a matter of fact, last week I had a couple of clients call me, seeing if I can do a home equity line of credit. Of course, we can do those. We could offer that. But one of the caveats was I have a ton of equity, but I have no job. Well, how do we
prove the difference?
That you can support your house payment and that new equity line of credit? So we're like, do you have a job offer letter from another company? He's working on it. But that was the same, story that I heard from the last two clients, and those are the realities that are going on right now.
Oh man!
These things
you weren't able to. You weren't able to. Do
can't.
It?
You can't.
Well, the reason I'm asking if you weren't because last week we were talking about a couple scenarios where people were just their consumer debt was like through the roof, and they're like was the saving grace was the home equity line of credit, but not in this case.
Yeah, which gets me to the next story here. That I want to share. People don't know this, and this is what's cool with this article. It's actually informing people the importance, right? And this is like whether consumers make on-time payments. Well, making on-time payments, that's around 35% of your credit score, which is awesome. Yes. That's pretty high up there, Then the credit utilization, that means how much credit card you're using on a regular basis. That's 30%.
Yep.
Yep. And so right now, the most important, what's impacting people is that credit utilization. People are using their credit card in order to pay their debt. So they're kind of using like, what do I have? I don't have money in my bank account, because we already know we're one of the nations that save the least amount of money anywhere.
Debt driven.
Yeah.
You know what I mean? So we're going to use our credit cards, and that's why it's at that 1.12 trillion.
And you combine those two things, and you have 2/3 of your FICO score from those two elements.
Absolutely.
So, your payment history and the utilization rate.
Well, the utilization, I want to go to that, back to that on a story. Right now, I'm working with a client that we're doing a VA cash out refinance. I reduced their rate down to 2.25. They were at 740 mid credit scores. When I did that, I ran credit. She was at 608 and he was at a 648.
What?
And so I'm looking, what's late? What did they pay late? There was no late payments. All payments being made on time. 35%.
It was utilization. No way, really?
It's $102,000 worth of credit card debt.
Oh my God! Wait, what?
And then it was another $75,000 in just installment.
Oh my gosh!
But the cool thing here, the cool thing about that is we're moving forward, but we have to do a rapid rescore. Luckily, when we run credit, we're able to know what we have to do in order to get that credit above a 640. That's the goal, so that at least the interest rate makes sense for what they're doing. But even at that 6.25 that we're going to get them, Andy, after paying off all that debt, which is we're taking $170,000, after paying that debt, excuse me, they're going to save like $2,500 and change a month.
Monthly out of pocket.
Out of pocket. They're just going to save. And remember, we only calculate the debt, the minimum payments on what's shown on the credit.
Which is not, know. Which is, dang, that's a lot.
Yeah, so I'm easily thinking that's going to save them around $3,500.
Yeah.
So
that's crazy.
I told them from that 38, you're going to go to $6,500. But now remember, you don't have none of that installment loans.
Back into your loans.
You do have your car loans because they have car loans.
Oh, okay.
And a student loan, not that high, but at least we're paying a lot off.
Before we continue though, can you please explain a rapid rescore to anybody who doesn't know what that is?
Yeah,
can you tell everyone what that is?
When we run credit, when we do a rapid rescore, what we actually do is we want to pay down some of those credit cards to a certain percentage, and normally it's around 30% or lower
of the balance
of the current high credit limit. High credit limit, actually. So some of them, like we just had to do 3 cards in this case, and it was like a total of $1,400 and change. And then so when they give us letters providing that, okay, they paid it down, we'll go to Equifax, Experian, whatever credit bureau in there, we'll submit that, and it takes about 5 to 7 business days for them to reflect that. And then the company that we run the credit through, they'll verify that information, and the credit increases to where we need it to be within that 5-7 business days.
So this is a method for those of you who are interested in this, you're trying to refinance out, or you're trying to figure out what to do regarding your credit, and then maybe it's plummeted from a 740 to 608 or 648 or whatever, and it's because of utilization. The rapid rescore is a way to do this quicker than the normal cycle. So if you had paid it off today and you had to wait 30 days for it to report, you can do it through rapid rescore through the system that we have, and everyone else has too, in order to get your score re-rated between your last payment period and the next one.
Yeah, and the reason why we want to do that is because there's tiers, right? So it's going to be, we can do the cash out at 608, but the interest rate's just going to be terrible.
Yeah.
So if we pay $1,400 for this, and we share that burden, we cover the cost of doing the rapid rescore. This is not something that gets passed on to the client. That this is a service that we provide, right? So if we get up to that 640 tier, the rate's a lot more favorable. It'll go from that 6.875 down to a 6.25.
Yeah, absolutely.
That's a lot. $300-$400 difference a month.
One of the conversations I had last week with the client was between a HELOC and a cash out refinance, and we ran the numbers. If they would have done $100,000 on a HELOC, their rate would have been 11.5%, and the payment would have been like $990 additionally a month.
Yes.
So sometimes, and I always say, just compare both. Even if you don't have the want to do a cash out refinance because you don't want to touch it first, run the numbers. That's gonna give you an honest opinion. But we ran the numbers at a cash out refinance, and same thing, consolidating the exact same amount of money, getting them the exact same cash out. Their rate was going to go up 0.375 from a 5.875 to a 6.25, and their payment only goes up $773.
Okay.
But it's not going up. Their out of pocket is going down, right?
Yeah.
And then there's a difference. I asked them, how much are you paying a month in monthly debt? She's like, $2,400.
Oh.
So I'm like, okay, so now you take off that $2,400 plus the $773, and that's the difference of what they're taking home. And they're like, hey, well, we were already used to paying $49, $60, whatever. So we're gonna throw the difference of the money and just put it right back into our mortgage and be debt free, but be able to pay our house a lot faster and just be able to call it a day.
That's the way.
Yeah. And what I want to drive home is that everybody's infatuated about getting a HELOC because they don't want to touch their first loan. But honestly, once you run the numbers, you're going to clearly see that even if you get the HELOC, don't touch your first, you're going to be paying more regardless. And the advantage with the cash out refinance is that you don't have to later down the line refinance that HELOC out or have to pay it all off. You continue to make your one payment at a low rate, consolidated 30-year fix, and then you just pay off all your debt freely and clear.
Yeah, and here's the other thing with the HELOC. The interest when you're using it to pay off debt is not tax write-off.
It's not worth it, yeah.
It's not a tax write-off. So that's another good point that you got to actually see, right?
It's not mortgage interest.
It's not mortgage interest unless you do home repairs and you're doing something there, and you're going to have to prove that, right? But
that's not what we're talking about.
No, so these people are going from a 6.25 up 4%.
Yeah.
You know what I mean?
Yeah.
But the whole goal is, like, hey, stop making those payments there. And I share the same thing with them. I'm going to share the mortgage accelerator calculator with they pay $500, $1,000 back to their mortgage because they're already used to doing that. Now they're reinvesting into themselves. And it's going to take them, it was going to take them 7 years to replenish everything that they used by taking this route. And now the mortgage interest is a tax write-off. And therefore they'll get more money at the end of the year because of it. So there's a lot of good, a lot of pros for this.
You have to be tactical about this.
Very tactical.
We talked about this last show, and I was kind of saying to people like, hey, listen, like we're not saying that, hey, you made a lot of bad behaviors financially. Let the house be your rescue. I mean, we are saying that in some cases, but tactfully. Don't just go into it like without a plan, but coming into a plan puts you in a much better situation long term.
No, absolutely. But you know what, Andy? In some states where you go, luckily we have that.
Yeah. Right.
Luckily we have that.
Well, yeah. What would be the alternative?
These people is a sinking battleship for them, right? They bought a nice investment for their family, but they're getting over their heads where now it's going to become difficult to start making their credit card payments.
Because for some people, the solution is selling the house, which means now you don't have the house.
So luckily, we saw this appreciation. Now it's time to leverage. Now it's time to utilize that equity, and luckily we had it. 2008, 9, 10, that wasn't the case.
So one of the things I just want to I wanted to make sure I made a point of, because I'm a little bit more of on the bitter end of what the Fed does, is they're talking here about how first of all, I think there's a warning sign with our total balance of consumer debt being over $1 trillion, number one, and growing. I don't like that, and that the 8.9% of credit card balances became newly delinquent for the first 3 months of the year, the highest in 13 years. That's a warning sign. Warning sign to creditors. You better watch out. The Fed is not going to come save you, people. The Fed is not going to come save you, creditors. And here's why. Even though they want to have a 2% inflation, they're not going to be able to walk back the year that it was 9, the year that it was 8, the year that it was 6. It's already up there. It's elevated. It's staying, and it's just slowing down at 2. So unless you get your arms wrapped around your debt right now, you're going to be facing an uphill climb and an uphill battle. They're not coming to save you. Work with your home equity to figure out a solution. Do it tactfully. Do it smart. Change your behaviors. If they're bad behaviors that got you into it, let's work on some new behaviors that can help you get out of it.
And I'm going to piggyback off that. When you're looking to do a HELOC and a cash out refinance, a HELOC is going to be heavily dependent on your debt to income ratio and your credit. So that means that if you have high balances, all your credit cards are maxed out, you have a very, very minimal chance of getting approved, because they know exactly what you're doing. Yeah. And they know exactly what you're going to use that HELOC for, right?
They're seeing it.
The story is there.
Yeah, but on the flip side, with the cash out refinance, they allow a lower credit tier. You're able to have a little bit more leeway of what you're going to use those funds for, and you might have a better chance of getting your loan approved. Yeah. So if you're looking to get a HELOC, make sure you do it before you start running up all your credit cards and it's like, hey, I really need it. I'm drowning. No. Take your time and do it beforehand, because you could also be hurting yourself if you do it at the last minute.
That's right.
And there you go.
Yeah.
Which gets us to that next our next article.
Yeah, rounding us out today, guys, we have the mortgage refinance demand jumping to a 2-year high as interest rates drop. Hey, what a perfect segue from our last conversation. What do you know? There must be a nerd around here somewhere. Applications to refinance a home loan jumped 15% last week compared to the previous week, and the average contract interest rate for a 30-year fixed-rate mortgage with conforming loan balance decreased to 6.87% from 7%.
I have a really good example for that one.
Yeah, so I want to talk about that. But before we jump into that, I have a question for you guys. So here's the last point. Applications for a mortgage to purchase a home fell 3% for the week and are 14% lower than the same week 1 year ago. Here's my question. Is this an inventory problem, an attitude problem, or both?
I think it's both.
Why?
I think it's both because, a client finds a house that they want, but then they struggle on the price. And I've seen it sometimes where we like the house, but it's just too expensive. Yeah. And then, there's no other option. So then you either have to, make the decision, or you're just going to have to continue to wait until you find something that, is enticing for you to want to buy at the price point that, they're selling it for. And I think it's a two-road type of thing, because, you're also looking at it as your primary residence. It's an emotional decision. But if there's not enough inventory, then that also plays into your emotions, because you can't find what you like.
Okay. Yeah. So what would you say? Inventory, attitude, or both?
I'm going to say both. I mean, inventory is still the thing. And so it's, Brian just brought out a point earlier when we started. There's a home that's 1.8 and now they're offering 2.1.
Right.
It gets discouraging.
It's getting away from you.
And that's because of the lack of inventory too in certain areas. Yeah. So again, I'm talking about here, right?
Yeah.
If we're talking nationwide, I'm still going to say it's both, because we're all having shortage issues.
Yeah.
And I think, why did they fall? I think it's because people are starting to realize, rates are going to start going down.
Yeah.
Inflation's better, unemployment's higher, and so therefore, it becomes their attitude, they're paying attention to these things that are in the media and stuff about the, unemployment rate increasing. People get worried, right? So it becomes now like, hey, I'll pump the brakes on that and see where the rates go, and let me just kind of wait it out for a little bit.
And, I'll say this, again, off camera in our private life, our personal life, we have some friends who are very highly qualified in their field and their trade, and they're 15, 20, 25-year veterans in what they have done professionally, and they cannot find work. But part of that is their seniority, and part of that is just the lack of availability of that said job at a different company. So I know that that's happening. In general, I think the squeeze is on. I mean, it's the squeeze on inventory. You got the squeeze on debt ratios when it comes to qualifying. You got the squeeze on rates. You got the squeeze because people are spending they're using their credit cards to spend for everyday needs. You got the squeeze everywhere.
Totally. Especially here in California.
Yeah, absolutely, and in every other, let's say, high cost metro that's listed on the top 100. It's Houston, Miami, other other states that have their biggest city, they're having the same problem too. Now, I'm not going to sit here and claim that, we aren't better off than most people. We certainly are. I understand that. Like, you guys have a studio and you have lights and you're obviously using nice cameras. I get that. Don't hate. The point is that, look, everyone's feeling some level of squeeze right now. And even though mortgage refinancing has like jumped, it's to what we talked about in the previous segment. It's mostly solving a problem. Refinancing is to solve a problem. It's not because the rate is better. It's because there's something else that's more threatening than the refinance itself. So the refinance is a solution. And even though rates haven't like completely plummeted and come down into, let's say, really favorable territory, they've come down enough for people to go, okay, maybe I'm going to have to do this in order to fix this other problem in my life and free up cash flow from out of pocket. It's just where we're at.
You know, the great thing about all of this, Andy, it's mathematics. It's not going to lie to you.
Right.
If you're going to, if it pencils out and it's telling you, and then you're putting in a different perspective as to, well, how do we utilize this cash that you're taking out, not to go buy a new vehicle, not to do a certain thing. Now, if you have the financing, you're able to do, well, okay. But why would you pay 11% or anything like that, on something so high when you can just go, I just said one of my friends got a Tesla at 0%. Chris, right?
Oh, yeah.
At 0%.
Because they had it, they ran a deal on the Model Y.
Right.
And then they ran another deal like on the Model 3, I think, right after that.
So
for
at
0.9% for the Model 3 or something like that. I'm
Makes
like,
sense.
Which is crazy. He said he's going to pay about a little over $1,000 in interest.
Yeah. Isn't that
in
crazy?
the 5 years. That's nuts. So, I mean, I really think it's how you're leveraging your situation. Again, the math doesn't lie. Like, he did the HELOC with the mortgage payment, and I know there's a blended rate. If you got 11 or 12%, and then you got a 3.5,
right.
You got your blended rate.
Yeah.
But sometimes even just taking it out, making all that interest, the bigger picture, a lot of times is just done.
So I think that this is like, it's a good sign for the mortgage industry, but it's not because of a good reason. It's like, this is working in the right direction. It looks like it's getting healthier in this segment of the industry. Well, yeah, kind of, but you got to look at the reason. It's not always just like, sunshine and rainbows. It's because people are having a real bad day financially, and this is their way out of it.
I mean, right now we're running a special on all VA IRRRLs and FHAs.
Yeah.
And we actually were seeing a 5.625 at no cost to the client. That's in conforming loans. It's pretty crazy to start hearing that, right?
Yeah, mid fives.
Yeah, it's like we haven't seen that in.
When's the last time you said when's the last time mid fives came out of your mouth? Like 2022.
Yeah, 2022 towards the end.
2 years ago.
When I locked in that purchase that I'm not refinancing.
Yeah.
The last time I did your loan.
Yeah, exactly.
Oh my God.
But yeah, we're starting to see that. Inflation started. I know the Fed wants it at 2%. We're starting to see it. I think this Friday we're going to see a little higher than anticipated, but
probably.
So here we go with the volatility of rates, but at least now, and then we're starting to see unemployment. Unfortunately, our government wants to see us unemployed. They don't want to see us spending our money because that's all due to inflation. So
it's like a solution for
a good thing.
Solution for demand destruction. But the problem is we're still soaking up demand by using our freaking credit cards.
Exactly.
So it's not really destructing anything yet.
No.
One of the things I appreciate about our industry is that everybody's so positive when it comes to talking about the rates. You'll see like 7% down to 6.87. So I penciled the math out, right? So if you do a 766 500 purchase with 5% down, going conventional loan, $100 in insurance, $798 for property taxes, and $127 for your mortgage insurance, you get a payment of $5,870 with 81 cents. But hold on, rates came down last week, so that same scenario at 6.87 gives you a payment of $5,870 and 40 cents. A saving of 41 cents.
Hey, that's almost $50.
Let's get in the market. It's hot.
That's almost $50. Wow, that's amazing.
That's a great one.
Yeah. So it's always interesting how you can like spin. Like any news is good news, even if it's just by a thread.
I've been cooked in my comments and my stories on Instagram because I'll post like rates are down, and then it's my buddy, from 7 to 6.99, you dick.
Yeah. They're like my plane is making its final descent. We're not at 30,000 feet. We're at 28,000.
And I just gotta be honest, hey bro, I have to sell, bro. It's my job.
No, I mean, the good thing is, not everything's a sell, right? I mean, the facts are the facts. Yeah, last week, I mean, like you said, we locked in a few clients. They went from a 6.75 down to a 5.625. That was a huge difference. That's like $400 some right there.
Shit, I'll take it.
On the loan amount, that's a big deal.
Yeah,
I mean,
and it's
look,
an earl, no out of pocket. Like, dude,
because at
that's
that point,
why I believe that this has increased because we've been seeing an uptick on it.
Yes, because at that point now the person who's in that situation has to wager. Why wouldn't I do that? Oh, I'm not gonna. I'm saying no to saving $400 a month or $500 a month
because I want to save 800 to 1,000. Like, come on now.
Imagine this. Okay, be a viewer and imagine your financial situation where you'd be able to go, yeah, I don't need to save $400 a month.
Yeah.
That must be a nice situation, isn't it?
Very nice situation.
If you're not in that situation, guess what? People are saving $400 a month or $500 a month because they're using the Earl and the FHA Streamline. Yeah. So I think this is a solution. I think it's going to be more of this. I think you get June's data in July when all the June data comes in, all the July data is concluded. I think you roll into the fall, you're going to see that summertime we're actually kind of pivoting and kind of coming over this hump on the horizon of refinancing and coming back because people need to, not because it's just a nice rate.
Winter is coming.
Winter.
It's coming. All right.
Did you have another point on that, Brian, or you just want to say winter's coming?
Winter's coming, and then we laughed, and then I kind of lost.
Okay, you lost the train of thought. Memo. No more new thoughts from Brian today.
Nope. Done.
Yeah, all done with that. So,
thanks, guys.
Yeah, you guys, great job on today's show. Thank you so much for joining me once again. But before we go, what was your favorite part of the show today, Memo?
Obviously, it's going to be the fix and flip.
Obviously, okay, that probably should have been obvious to me. Okay.
Yeah.
Okay.
I'm going to be right there with Will right now. I think we're on a fix and flip like frenzy. We're just like all about it, and it's not just because like. We knew about it before, but now knowing exactly how you could strategically, put everything together, it's just exciting to be able to help people get into their projects, learn about those projects because we also want to invest in other stuff as well. So it's just opening up the world to a whole different realm of investing and financing. And I'm really enjoying this time right now.
And the appreciation from the investors. You never thought you'd get so much kudos because you feel like they know it all, right?
Yeah.
But they're just regular human beings, just like us.
Yeah. Well, they had their day. They had a day one.
Yeah.
At some point, they had their first day, their first flip.
Even the more experienced investors, they're so seasoned. They're so grateful. Like guys, Brian sometimes look at each other like, what the hell? Doesn't everybody offer this?
Yeah.
But we just seem to get creative with certain things. You know what I mean?
Yeah.
That we've been working with John.
Yeah. Hey, John.
And I mean, he owns now properties that he'd never owned before.
Right.
It's since we've been working together the last 3 years, he owns several properties now.
Yeah.
And he's done ADUs. And, I love seeing that season. He's been doing this for the last 14 years.
Yep.
And now he's building a real estate portfolio. I don't want to pat myself on the back, but I am patting myself on the back.
But you're part of that journey. No, you're part of that journey.
Because we help them understand what an exit strategy should be, whether you're going to keep and hold this. And I just always fix and flip. Fix and flip, here's the thing. You make good money, but you build wealth when you keep these properties.
Right.
So,
and you have another client who is actually now using one of our content producers, separate from what we do here in mortgage land, using one of our content producers to make content strictly about buying investment properties.
So he's not even a lender, which is crazy.
That's right.
No, CTS.
Chris. I didn't want to out him, but you have one of your clients who's actually doing the stuff we're talking about right here and started that journey with us. And I'm super proud of you for doing that.
Yeah, no, thank you.
He got that. I know he's getting a lot of inspiration from that, but he's also getting a lot of help from that too.
Yeah.
So,
and even for the, sorry to cut you off, but even for the younger generation, we're working with a few investors that are also young. They're 26 years old, 24-year-old contractor, and they're out there working on multiple projects. So you don't have to be older. You just have to have the right team, get the right resources, and have your I's dotted and your T's crossed.
I know who you're talking about because I saw some of that content this weekend, and they're doing flips in 7-figure neighborhoods.
And it just feels I feel so fortunate to be able to be a part of that and be able to help that. It's just I helped make this happen, and we're helping making this, come true. I'm like,
what's his name in the corner? Like, I don't even want to be here right now. Like, wow, okay, well, you got to.
He's like, I'm at a multi-million-dollar flip. He's like, oh no. Hey, after they had just put up their La Jolla project up for $3 million and already have offers on it, I'm like, come on now.
He admitted though, he's like, I already had a long day, so I was like, I don't want to be here right now. I'm gonna take a different course. I know you guys. I guess I should have recognized that you guys' favorite.
Okay, take a guess. Which is gonna be?
What do you think my favorite part of the video is gonna be today?
I think it's gonna be the one with the most data.
The one,
which is the U.S. FICO.
Dang.
I was going to say FICO too.
U.S. FICO score. Canary.
Oh boy, do we know each other.
Man, I guess I really out myself, don't I? Okay, here's what I wrote. The FICO score is my favorite part of the show. Canary in the coal mine. I think this is the canary in the coal mine for other broader debt problems we're facing, not only just as a country, but as an economy at the consumer level, and then just spilling over to everything. I think creditors are going to face a uphill battle when it comes to protecting and preserving their extension of credit to people who cannot pay it back. And I'm not sure what lengths they're going to go to try to recuperate that, but the fact that we see accelerating and ever increasing total balance of consumer debt is a big concern to me, because I don't see a solution being offered on the other end of that. And unless people are personally making more money more often and able to pay that down, they won't and they can't. And that's just going to spill over into a broader problem. So I'm saying canary in the coal mine. Sorry to be the Debbie Downer. Wah, wah, wah. But that is interesting to me because I look at what's coming up ahead and try to pace where we need to be as a result of that. So thanks for letting me nerd out. I love you guys very much. I appreciate it.
We do.
Yeah. So, thank you guys all for watching, by the way. Remember to like this video, subscribe to the channel. Also, check out our playlist called Friends of Mortgage Heroes, where Brian, Will, and myself interview friends in and around real estate about their successes, their trials. And remember to comment and let us know what you like about the channel, what you want to see more of, and what you want to see these guys talk about. Because basically, I won't schedule them for things you don't want to see them talk about. Exactly. How about that?
That's good.
Okay. All right,
All right.
Oh, whoops.
Yeah.
Thanks.
Well, thank you guys for a great show. Thank you all for watching. And
thank you.
We'll see y'all next week.
We'll see
Bye,
ya.
guys.
See.